The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us, and great to welcome my co-hosts, Elliot Turner and Phil Ordway. We have a terrific topic for discussion. Elliot, over to you to kick us off.
Great. Thanks, John. And, it was great to see some of you in person last week at the Markel annual meeting. It's become an event, so that was a pretty cool experience. So thanks to everyone who came up and said hello, and look forward to seeing you all again. Today, we're value investors, so we like talking about what isn't working in markets and where there's potential for a contrarian angle. Few areas are as out of favor right now as commercial real estate. It came up several times over the last week in conversations, and I've been paying attention to some of the heat and some of the action that's happened in the stocks, giving them a look. And I think it's a really interesting topic. It has several potential consequences. And I feel like there are a few interesting paradoxes to what's been happening in this space. So obviously the first cracks emerged with questions about work from home during COVID, when everyone who wasn't an essential employee in an area that had to serve people's key needs was working from their own home, working virtually. When we were doing Zoom, and we're recording this on Zoom, so it's still around in some ways, but nonstop Zooms all day, every day. And then as things started getting a little better with the COVID situation, there was talk about hybrid, key debates about a post-COVID world. Would people be totally virtual? Would there be hybrid that's 3 days a week or a 4-day a week with 1-day flex? As well as, would big cities maintain their kind of gravity for population, and or would people become a little more keen on living in the mountains and spending some of their time working virtually, but having kind of like a city enclave? These key questions, they've morphed into a degree of permanence with the post-COVID overhang. And I think, it's kind of evolved in terms of the conversation. So that was the first degree of pain in office space in particular. But the second degree of pain has been more recently, where you are seeing, as a consequence of all kinds of dynamics, increasing layoffs. You're seeing rising interest rate stress at some of these companies where, and I'll talk a little bit more about wall of maturity. But those two dynamics have kind of taken over. So the layoffs and shrinking footprint of some really large companies, as well as the impact of rate hikes. And, that has two impacts. One is on the actual way that investors value these properties. So cap rates start rising. And the other is on the cost of debt for some of these REITs and owners of properties. And, let's talk first about some of the occupancy issues. Occupancy is finally back above 50% nationally for the first time since the pandemic in office space. Financial firms were some of the first to go fully back, but you're starting to see it happen everywhere. Was looking at a Gallup poll from not too long ago. 50% of people said they were working hybrid, 30% were fully remote, and 20% were on-site. So at the peak of the pandemic, we were looking at something like 75% of people working fully remote. So we've come a long way. And that 50% occupancy that we have today, I'd imagine it means that more than 50% of people are going to the office every day, because you do have that hybrid component. So maybe in some cases, you're balancing some of the workload, some of the office load throughout the week. But even with this improvement in occupancy, like, these stocks keep going down. Vornado and SL Green are down nearly 40% just this year. And part of that, I think, is because a major market like New York City in Q1 of 23 reached 16% vacancy rate. That's the highest rate in a very long time there, despite the rising occupancy. And, that's despite pressures like, in a memo not long ago, Mark Zuckerberg wrote that everyone should be going back to the office, that new hires perform better when hired in person than virtually. 3 days seemed to be a key number for him, invoking 3 days being what was critical for that better performance. Disney, when Iger came back, one of the first things he did was a 4-day-a-week policy coming back. So, like, California has similar trends to New York. Starting to see that start to turn around. And I think what's notable is that a lot of this comes alongside large layoffs at these companies. So what you have, in effect, is, during the pandemic, really tight labor markets perhaps gave employees a little more leeway to say, hey, I want to be virtual forever. And now that the pendulum has swung, employers have the leverage and are saying, no, we want you back in the office. Yet still, when you're shrinking your workforce, you don't need as much office footprint. So perhaps that's one of the big changes. And then you see something like co-working space. WeWork was surging well before the pandemic. That stock's obviously not done very well for a slew of reasons. But co-working spaces continued to gain in prominence. And perhaps some of these large employers are starting to think that workers want flexibility, and so too do landlords, that you can flex up or down your office footprint as your needs evolve. And maybe it's just not worth owning buildings anymore. So I know one company like Dropbox, they went fully virtual, but do have some office space that they leave for employees. And they do have some employees going in, but they are subleasing almost the majority of the headquarters they built not too long before COVID. And then, I referenced it before, but I think perhaps the biggest part of the stress in the office REITs is this wall of debt maturities. So unlike most households, commercial landlords, they can't just easily, refinance to super low rates and pay off their mortgage when the time comes. The debt's structured a bit differently. So there's this tweet storm by RXR CEO Scott Reckler. He's that company's a big owner of office space in New York City. And he cited this fact that there are 1.5 trillion of CRE debt maturities coming due over the next 3 years alone. It's the biggest wall of maturities in the space. And this maturing debt will have to be replaced with much more expensive debt. And that's not to mention the fact that some of this floating rate debt is already way more expensive. And so you have the situation where occupancies are down, which leads to values down. Rates are up, which leads to values down even further. And so the debt burden has gone up in these in this space. And then now just suddenly you have to refinance into much higher rates. And, there are big questions about what happens next. So, one of the things I'm asking myself is, are there opportunities for value investors? Are there constructive ways we could think about this? Or is this something that we should be worried about could have potential negative consequences beyond even just the CRE space alone, where banks, for example, own a lot of the debt, especially regional banks. And so could that compound some of the problems that we talked about with the banking sector? So anyway, these are some of hoping to lay the land for the conversation. And those are a couple of the questions that I'm considering. What do you guys think?
Yeah, it's a great topic, and it seems pretty timely. And I feel like it would be, I would be remiss to not start this with a bit of a memoriam here for Sam Zell, since we lost him last week, which was really sad news for me personally.
Yes,
I mean, one of the great all-time titans of the real estate industry. And look, I'm not a real estate investor or expert by any stretch. I have done almost zero in the sector, but I did know Sam Zell just a little bit. I was actually a Zell scholar in business school, and kind of kept in touch with him a little bit over the years, and hadn't talked to him in a year or two before his passing last week. But just can't say enough good things about him, and really always enjoyed anytime he had anything to say, I thought he was just chock full of wisdom and common sense that's unfortunately uncommon, and was a truly generous and wise person in a lot of ways. So it's a good time to pay homage to him and talk about commercial real estate here. And it's funny too, because I was just this morning listening to an interview that somebody sent me that he recorded sometime, I think about 2 months ago, certainly this year. And he made the excellent point, as always, that it shouldn't be a huge surprise to people that we're having a drawdown in commercial real estate, particularly in office space, because for him, almost everything came back to supply and demand. And, big commercial buildings take years to plan and permit and develop. And, starting about 10 years ago, a flood of money coming into the market, largely due to low interest rates, started just pumping up massive amounts of supplies in basically every market in America. And then you had things happen like inflation and rates going higher with the, of course, once a generation shock from the COVID pandemic that you just talked about, Elliot, and here we are. So, and it is notable too. I mean, he took over a portfolio. Sam Zell took over a portfolio that he took over and renamed as Equity Commonwealth about 10 years ago. And I believe the numbers are something like 100 properties, 100 buildings that he's sold and liquidated. And he's basically he hadn't bought a single thing, or maybe one or something. So he was, cautious, and some would say that he was wrong because he was too early, but he was more than happy to do that. When he didn't see risk and reward balanced in his favor, he just simply would do nothing. He was more than happy to sit there and wait and wait and wait. And it's a shame. And so I would say from my perspective, and again, take this with, it's not worth a whole lot. You get what you pay for on this one for sure, but I just think it's early. I think this is a very slow motion train wreck where we're just now starting to see. I mean, I just saw that Brookfield handed the keys over to the EY Tower in LA, in downtown Los Angeles, just today. So, we're just now starting to see actual distress. And I think the vacancy rates and the releasing rates and the net absorption rates are all very indicative of where we stand, and certainly where things are headed, I think is relatively clear. But what's of course difficult, and where the money is to be made and lost, is the judgment about what the right price should be on these assets. And I don't know. I look around. I mean, for example, Elliot, you brought up Vornado, and SL Green's another good example of it. Look, this is not investment advice. I don't own either one. I'm not short anything, so I'm not talking my book in any way, shape, or form here. But I was just looking at it, and the numbers are pretty staggering. I mean, Vornado, just to pick one, at a current price of $13, the stock is like a third lower than it was at the very low point of the global financial crisis in 2008 and 2009. It's gotten absolutely smoked. The market cap's down to about $2.5 billion, and there's $10 billion ahead of you in debt and preferred. But,
and they cut their dividend to zero.
Yeah, that's funny because it does still show up as, for whatever reason, some of the forward estimates are still anticipating that they turn the dividend back on, it looks like, which is kind of odd because they clearly have like very little prospect of earning that dividend. So I don't know at what point they would ever find it palatable to turn the dividend on. I mean, and it's funny because this is a classic example of where people say, oh, well, I'm sure before they cut the dividend, well, look, everybody needs a commercial building, and they're not going to all go to zero, and I'm getting a yield of whatever. I mean, what was the yield on this before they cut it, Elliot? Like probably double digits, right?
Well, it depends which price you're measuring from, but yeah, it was into the double digits when they actually made the cut.
And now and now you're getting, instead of double digits, you're getting zero, and you're probably underwater. You probably have a capital loss on the position. So it just highlights how dangerous these things are. But anyway, I thought it was really interesting too. There's only a couple of bond issues here, but the 2.15% notes, which is amazing enough that the coupon's that low, because they were issued in May of 2021. So good on them for timing the market just perfectly. It's a $400 million issue. They're only yielding like 9.3%. I mean, they're at 82 cents on the dollar. But, I mean, Fed funds are 5.25%, and I can get T-bills and money market funds that yield 5%. Why would I want this at 4% more? It's just kind of bonkers to me. So I don't see a ton of opportunity yet. I will say, though, Elliot, you raised a great point. I mean, one thing where I hope at least a little bit qualified to render a useful opinion is in the banking sector. I would be very, very surprised if this leads to any sort of significant banking crisis. I would expect that this leads to pain in the banking sector because loan loss provisions and allowances have been at very low levels for years, obviously, because between the combination of a well-performing economy and the COVID-19 stimulus that was distributed, there just weren't a lot of losses. And banks are actually restricted in many cases from provisioning in advance of any sort of credit deterioration. So now that the credit has in fact deteriorated, they basically have no choice but to finally take the provisions, and that's going to be charged through earnings, and earnings are going to go down, and it's going to eat a little bit into capital. I would not expect this to be any sort of disaster for most banks. Now, undoubtedly, there are some banks that are super concentrated that had very sloppy underwriting that will have some big losses that will be painful hits to the portfolio. But I don't think this is going to cause, I mean, look, it could cause a run on deposits, I suppose, because as we just saw with several banks in March and April of this year, it doesn't take much to spark a run on deposits at a poorly run bank these days. But there's no economic reason why this would be a total disaster. It would, in my opinion, be far more likely to just be a slow bleed that comes through earnings. And is somewhat painful in that regard. But, given that the vast majority of these loans at most banks were made at reasonably responsible LTVs of 50, 60, maybe 65 or 70% at the very high end, they should have plenty of cushion there. They're just going to have to provision for that loss that they're, whatever the loss ends up being. So to me, it looks more like a slow motion train wreck than it does, something that's going to be really, really ugly and painful for the next 6 months and then be turned around at some point. I mean, my guess would be, given the massive amount of oversupply, that we're still talking about this, 2 years from now. I wouldn't be surprised if we're still talking about it 3 or 4 years from now. I think there's that much to work off. Another great point that Sam Zell made in this interview I was listening to was that not only did you have a massive amount of oversupply because of interest rates and because of over ambitious developers, but you had a lot of artificial demand where all these shared working spaces, and these idiot companies like WeWork said, well, we're just going to gobble up as much possible space as we can find, and we're going to sign 5, 7, 10-year leases on spaces in demand in advance of the demand even developing. And that's obviously gone down the tube. So you had a combination of like, well, we're overbuilding, sure, maybe a little bit, but we're also meeting all this demand that's popping up, and both were overstated, right? Like the supply was way out ahead of what it should have been, and the demand was overstated. So the supply was kind of like doubly high. So I think it's going to be pretty ugly for a while.
Yeah, no, it kind of makes sense. And you look at the equity of Vornado, I mean, it's basically 20% or less of the enterprise value, depending on how exactly you look at their total debt load.
Yep.
Which is, the market's calling this a levered stub at this, or making this a levered stub at this point. A lot of its value is going to come from optionality on figuring out what to do. And that's a good point on the banks. I think that makes a lot of sense, that it's not exactly going to be this massive calamity, but that it'll be a slow bleed.
Yeah. That would be my guess. I mean, again, we talked about this for anyone who missed it on an episode a couple of weeks ago about the whole banking disaster. A friend of mine who's long short called me and said, hey, have a look at this balance sheet. And I looked at it and I about fell out of my chair because it was the dumbest thing I'd ever seen. It was Silicon Valley Bank. And he called about it in August or September of last year. So he was short it the whole time. And we'd been talking about it and trading notes on it, for the ensuing 7 or 8 months before it failed. But I was still stunned that it failed, right? I did not expect Silicon Valley Bank to fail. I expected it to have a massive headwind, a multi-year headwind, as it dug out of this incredible hole that it had created for itself. And I expected it at some point to have to raise painful and dilutive equity capital to get out of that problem as well. But at no point did I envision them having a massive run on deposits to the tune of 40 or 50 billion, a huge portion of their deposits leaving in 1 or 2 business days. That was not something I would have assigned a material chance to. So I could be wrong again about some headline comes across that Bank XYZ is taking some massive write down on a commercial property in the portfolio, and they hadn't really provisioned for it, and now they have to provision for it and charge it off and whatever, and that spooks a run on deposits. I mean, that is obviously entirely plausible in this environment. I just don't think if you withstanding that, there's no reason the banks can't provision their way out of this and just charge through whatever the write downs happen to be whenever the NCOs come through. Like that, it's entirely digestible for them, right? They didn't make so many bad loans at such bad rates that they're all going to get swamped. I don't think this is going to look like the S&L crisis 2.0 in terms of real estate taking down the banking sector again. That to me seems unlikely, but everything else seems 100% in play.
So I know it's hard to prove counterfactual. Hard. I should use the word impossible to prove counterfactuals. But when you look at these office REITs, they are trading well below their COVID lows.
Yep.
And when you think about the COVID lows, I mean, I'd say it's safe to say that the majority of people, the world's evolved in a better way than we'd feared at the worst of COVID.
For sure.
And yet these things are far worse off. And so the counterfactual I'd ask about is, had it not been for rates at this point, would these things be better off in the market? Like, would they be substantially above their COVID lows? Or is there something else at work where in this slow bleed way, it's kind of like just the reality that even if it's not the worst case, it's like, well, the future of office is just way less good than the past of office. Is that what's at work? And I know it's hard to parse these out, but that's one of the things I wonder about, because I do think it's somewhat paradoxical that we're at this point where I'd say arguably the landscape for occupancy looks as good as it's been since February of 2020. And yet, the outlook for these companies looks as bad as it's been. So could you parse out some of that?
Yeah, it's a fascinating question. I think about it all the time too. And you obviously can't assign a single cause, an attribution to it, and you can't even assign exact weights to the various things. There's obviously multiple things at play here. But to your point, I mean, one thing that I think most of us wouldn't have envisioned, certainly me, I wouldn't have envisioned that COVID, when it hit, would turn into, I mean, I did realize it within a few weeks that most pandemics are most viral pandemics anyway, are about a 2-year ordeal. And because of some various, issues specific to this one, it turned into a little bit longer than that in many ways. I think most people would agree this was a 2.5 or 3-year ordeal in many senses. But at various points along the way, I think everybody, or most people anyway, still expected office occupancy to return to basically what it was pre-COVID. And I think that's been what has all come to the fore in the last 12 months. So coincident with this massive spike in interest rates, which is a huge problem, obviously, and we'll come back to that. You also had this realization that commercial office space is not going back to what it was before, and office culture is not going back to what it was before. And so I think what may be playing out now, and again, I was wrong about this for at least the first 6 months, 12 months of COVID. It was definitely into 2021 before it dawned on me. And I've made this point before, but I think it's proving out, which is that, before the Great Depression, the stock market was open half a day on Saturday, and most people went into the office on Saturday for half a day, right? It was a 5.5 day, 6 day a week, business and office culture. And as the Great Depression hit and just eviscerated demand, most companies found it expeditious to cut back on that. It was less a choice of leisure, I think. I mean, again, I hope I have the historical context right there. But in any case, I mean, the fact remains that, you used to have much more than a 5-day Monday through Friday office culture and business hours kind of culture. And then for a long time and a couple of generations at least, you had a very, steady, more or less Monday through Friday, 9 to 5 kind of office culture. And it occurred to me at one point that wow, maybe, I mean, with the rise of work from home and what's emerged is this hybrid culture, COVID-19 is probably going to look like the Great Depression in just creating a permanent shift towards a different work-life style. And, I think the data show it. And I think anecdotally, we all know most people that if they work at a company of any size, some of them are certainly back in the office 5 days a week, and some of them were always in the office 6 days a week. And, we all have our different rhythms and routines, but the prevailing office culture seems to have settled around 3 or 4 days in the office and 1 or 2 days remotely. And I think that's probably permanent and here to stay. And that's what I think has settled into the reality of the public securities that you're talking about here and the vacancy rates that you're seeing. And that, that's what's being discounted now into these asset prices. Again, I don't find the asset prices all that appealing because, to your point, Elliot, I mean, the equities are just being valued as a levered stub, which is fine, but they are very, very levered stubs. And I don't think they're trading at quite attractive option values or anything like that either. So it's going to be really interesting to see how that part of it plays out and what other curveballs are down the road. But I think, once the horse is out of the barn here in terms of saying, okay, we're settling into this new world of, the majority of people having a 4-and-1 kind of schedule, I don't see it going back anytime soon, even if we have a big recession. And you're right. I mean, employers have definitely regained the upper hand in terms of what they can dictate and what they can't. And I personally am a huge believer in that people do need to be together 2, 3, 4 days a week, right? You cannot, I personally think it's ludicrous that at the one end of the spectrum in January of 2020, the prevailing narrative was, well, of course, it's completely obvious that every bright human on earth needs to be physically together 5 days a week, Monday through Friday in downtown San Francisco. And within, a few trips around the sun, everyone has decided that, no, we're all going to work from our own little cabin remotely in the mountains of Idaho and never see another human being. Obviously, neither one of those is true literally in its polar extreme, but I'm certainly closer to the former than the latter. I don't think it's feasible or realistic for people to be fully remote in most jobs. Any sort of job that entails even basic communication and any sort of interaction with other humans. I mean, obviously, if you're a freelance writer or coder or something like that, I mean, there's plenty of exceptions that are obvious, but for the majority of people, I just don't see it as feasible.
Yeah, I tend to agree with that. I mean, it's really interesting to think about, though. The counterpoint to, I guess, why this reality would be suddenly dawning is like Zoom stock during the pandemic and the amount of articles that were saying, virtual is here to stay. So it's just mystifying in some ways. But I'd agree that if just the switch from 5 days a week to 4 or even 3, that proportionately reduces the amount of office space a typical company would need. Right. And it also means you could repurpose or proposition your office space. So one of the examples I'd heard is office space has become more for cooperative work in some specific companies, whereby a person doesn't necessarily need their own 4 walls. So instead, what you have is this open floor plan, and on open floor plans, you could fit far more people than you can when you do have 4 walls. Like just the walls alone take up some space in a footprint. So right. Formerly, you might have like 20 people in a floor, and now you could have at least double that.
Yeah, I think it's a double-edged sword, though, because I think before COVID, you saw a big push, maybe 5, 10, 15 years ago was the peak towards open floor plan offices. And I think the data and the anecdotes were quite clear that most people hated them. So you're right. I mean, it's an unassailable fact that as you go from required attendance 5 days a week to something less than that you need less space. I mean, that is patently obvious, but I've seen some of these numbers bandied about. They're like, okay, we were at 150 square feet per full-time employee before. And if we dropped 20% from 5 days a week to 4, then we should, slash that number equivalently. And I'm not sure that works, to be totally honest, but I think the numbers are also equally clear that, to me, the bigger issue is, yes, people are going to be signing up for less space as office spaces as leases come due. But you're putting that lower demand level into a market that's still so dramatically oversupplied because of just classic stuff, right? I mean, years and years and years of low interest rates, the classic timeless behavior of all real estate developers, which is, among the most pro-cyclical industries on earth. And then you get smacked head on with just this crazy double whammy of a pandemic for multiple years that makes a permanent shift in the demands for the office sector. and the three-headed monster then of rising interest rates. Because to your point, I mean, it's just like we talked about with the residential sector a while back. I mean, if you have a low rate on a building and you have it financed for a long period of time and your occupancy is X and you can make an NOI of whatever is acceptable to you, then you can play offense, right? And then you can go out and provide either better amenities or lower rates to your potential new tenants. Whereas, some office property that's coming up on, a refinancing or a maturity, I mean, they have a huge problem. And I think that's where you're just now starting to see that wave, like you mentioned, Elliot, of defaults and maturities that are coming because there's just no way around it.
Yeah, I would say you guys have hit the nail on the head. I mean, that is kind of the wild card this time around. Commercial real estate obviously has gone through quite a few cycles by now, but the whole, post-COVID work from home trend, that's the big wild card. And that's kind of what keeps me away from it. Even though I think if it was just, interest rates and inflation, you can kind of look through that perhaps to the other side. If, offices in general were basically same as always, because in my view, interest rates, they're up because of inflation, and ultimately inflation means pricing power or higher prices, including for things like commercial real estate. But because of the work from home trend, it doesn't seem like there's any pricing power in commercial real estate right now. So you kind of have higher interest rates, but you don't have higher rents, at least not at the moment. What's kind of interesting as maybe a counterpoint to this is if you think about some other industries that basically are going away, and one that comes to mind is coal. So just around COVID, thereabouts, coal stocks all looked like they were going bankrupt, and then they ended up ripping, 10x or more, because coal, while it's going away longer term, in the short term, it's still very much needed. And, maybe it's hard to kind of know over what time frame office space needs and demand will shrink. I do think that over the long term, office real estate will have to be converted, or at least a good chunk of it, to kind of mixed use, and so forth. So we'll just, we'll have to see. I do think you guys are right that it could be a slow motion train wreck, and that there's a lot more distress to come. It's hard, whether you can kind of pick your spots or not with a company like Vornado that apparently wants to do share repurchases. That's kind of a vote of confidence, and they do have a good track record with Steve Roth at the helm. But the risk, the kind of the unknown is just sort of what's going to happen on the demand side. That's why right. I'm more comfortable personally with residential real estate like apartments. And that's been hit just as hard in a lot of cases. I'm thinking of a German company called Vonovia. That's the biggest owner of apartments in Germany that currently trades at 1/3 of NAV on the equity side. And there, I don't have that concern as much. In fact, if there is work from home, maybe that means home real estate actually is going to have a bit of a demand tailwind, where people may add a room or something to be able to work from home. So, yeah, but great points. And, we'll just have to see how it plays out.
Yeah, so
John, are office occupancy trends like kind of similar in Europe as the US? Are people more back to the office, or
that was literally what I was about? That was literally what I was about to ask. Is like, I don't know much about where things stand in Europe, John. So where are things on the supply and demand? front in European office space?
Yeah, I don't have the numbers necessarily, but my feeling is it's pretty similar to the US. And you also have some other factors like the stress in the European banking system, for example, with companies shrinking their real estate footprint. Obviously, Credit Suisse is an example, but others like Deutsche Bank and other European banks, they've been kind of under pressure for a while. And all the technology trends that are in place in the US and globally apply to Europe. So I don't think it's much different on the office side. Yeah, it's really hard to say. I'd say in maybe on the interest rate side, Europe hasn't moved up as much yet, and that's just kind of a function of the European central bank keeping rates lower. But inflation certainly isn't lagging US inflation. So I think there's upward pressure on interest rates in the euro area. And again, back to the slow motion train wreck theme, right?
Yeah. Yeah. And one thing I would say.
That was such a good point you made on higher interest rates versus the lack of higher rents in office space. And it's a totally different dynamic than what had been going on in like multifamily, where there's tighter supply and you actually get some of the pass through of inflation, but also higher rates. And it's interesting when you look at a company, you mentioned the German company at a sharp discount to NAV. You look at a company like Vornado, it's half of book value. Maybe the market's saying, though the liquidity is not necessarily there, to sell down some of your book, shrink as a company, and harvest some of the value via the replacement value of it all. I wonder if some of these companies start doing that, do large asset sales in order to pare down their leverage and try to get something like, even if you sell at 80 cents on the dollar, it's a win for your share price from here.
Mm-hmm. Yeah, that's a great point. Although I'm not quite sure when you're talking 80 cents on the dollar, that's maybe a little bit low given how much leverage some of these companies have. But one kind of thing that stood out for me with Vornado as well was that they have I think a lot of the value is also tied up in the Penn Station development.
Yeah.
Which seems huge and ongoing. So they're not really getting the rents there yet, I guess, the cash flow or not what it should be eventually. And if in this market environment, and certainly if it gets worse, investors' patience to kind of roll over the debt for kind of new development projects or even just finishing such a huge project, I think that's another risk factor that you don't have with some companies, like the Vonovia that I mentioned, where basically they actually have been selling some assets at call it 95% of book value, which is pretty good. And so they've been kind of extending their own refinancing runway. So it's kind of on a case-by-case basis, but I personally would stay away from companies that have a lot of value tied up in projects that still need to be finished and require, additional investment.
Yeah, that's a good point, because one of the stories that Sam Zell told that I'd never heard was when he sold his equity office portfolio to Blackstone, and it closed, I believe, February of 2007. And, Blackstone ended up selling off a huge chunk of the portfolio to third parties. Almost all of those third parties took a bath on those properties, obviously. And then Blackstone had its own near-death experience on the real estate side with what was even left behind. They ended up doing well on it because they wrote it out and it recovered very strongly. But Sam Zell's famous for giving away these very thematic and memorable gifts. And he sent really nice watches to Vornado, actually, among others, who were the bidders that lost, so to speak. They did not win the bid. They didn't outbid Blackstone for this property, so he sent them all really nice watches, and the engraving said timing is everything, right? And I think that's exactly true in this case.
Amazing.
Right? Because the Penn State project, or the Penn Station project, excuse me, probably would have made a ton of sense if they could have gotten it done 10 years ago. And now it's just a complete albatross, right? I mean, I agree. Like, even if that project ultimately makes sense, if it gets done, sometime in the near future, and in 25 years from now, it's like a thriving development, like the timing could not be worse. And in real estate, it really, really matters. So it would make me super nervous as well. Could be really ugly.
Yeah, all this talk makes me think about the American Dream Meadowlands, which is kind of, I remember it most called Xanadu, that they started in 2004 and kept changing hands during the financial crisis. And it was basically like whoever touched it had something bad happen to them. And it wasn't finished until, I don't even remember the exact year, but maybe even like 2018 or 2019, something like that, nearly 2 decades after it was started.
Yeah.
But it's also, I do remember stuff like One Brooklyn, which was a major development when I was like coming out of law school, heading into the financial crisis. And that was thought to be a terrible like sign of the peak of enthusiasm in heading into the financial crisis. And it was like trouble for a little bit, and it's turned out phenomenally well. Now that we're 15 years past that event, Penn Station's kind of one of those places that's always been a center of the universe for anyone around the New York City area. But I guess as far as the problem goes for Vornado, they not just have this under earning on the asset. I think they still have some cash that they have to commit to developing it.
Right.
So, you get into some really tough questions about how you finish this from here, what you do, what the right choice is. And they've had great leadership, like you said, John, for a really long time. And these people have to see it through. But I agree. These things are scary to kind of step in front. And I do find it interesting that we're all contrarians to a degree here, but we're all in agreement that, this is not an area that we should be taking a stand in.
Yeah. I'll say this, though. I mean, to John's point a second ago, and to what you just mentioned there, Elliot, like in a different world where I knew what I was doing and I was a competent real estate investor, or to the point that something got totally obvious, I would do it. I think there could be, because if my slow motion train wreck thesis holds up, I mean, that over a period of time, I'm, envisioning like 2 to 5 years kind of thing, over which you reach a bottom and then things start slowly crawling their way to a better place. If I could find something to do along that way, and knowing full well I'm not going to peg the exact bottom, I am absolutely a long-term believer in both the value of cities and the value of commercial real estate and the value of office buildings and the value of human beings coming together for commercial enterprise. So if that wasn't clear, I hope it is now, because I do not, have any, dystopian views of like every downtown central business district is just going to be a hollowed out hellhole and no one's ever going to go to the office again. And this is like a permanent, secular decline in commercial office space. That seems completely and totally unrealistic in my opinion. So I would love to find something where, even with my limited experience and skill set, I could take advantage of it, where there was just pure psychology or panic or something, and there was something given away for, a very obvious discount. And look, I mean, it happened before. You did not need to be any sort of genius to look at GGP right here in Chicago back in the financial crisis, right? I mean, that's a classic example. And maybe things will get so bad, if we have a recession on top of it, or if the banking world comes unglued for some period of time or whatever, maybe you'll have something similar like that where it pops up. Capmark back in the day was one of the best investments I've ever seen in my life, because it did have residential exposure on top of commercial exposure. And at one point, as the company was approaching bankruptcy, it might have even been in at that point, but you could have bought the senior bonds, which were the fulcrum security, below the net cash on the books, and the company was not burning cash. It ended up recovering obviously well above that level, and then equitizing and returning multiples of the original investment if you'd have had the courage and the available cash to buy that security at the price that prevailed for a few weeks or maybe a month or two in late 2008, early 2009. So maybe you'll get some opportunities like that here. And if we do, I think we should all be alert to them. I just think that right now, I certainly don't see anything resembling that.
Yeah, and this is exactly what prompted me thinking about it, the paradox that I've been referencing before, because I deeply believe that the actual occupancy landscape is getting more, not less constructive. Things are moving in the right direction on that front. And yet, for other reasons, there are these pronounced pains in CRE, and there could potentially be things out there which stand to benefit alongside it, though it's also very much, a topic that I was contemplating for today is how much narratives are driving things, from stuff like AI, which is absolutely going bonkers today. We're recording this on May 25th, to stuff like the other day, all the CPG companies were down quite a bit. And the excuse was the GLP-1s are changing consumption habits. And this quote from Walmart about how margins could face incremental pressure because people's eating habits are changing. And it's like, oh my God, just a year ago, we didn't even have this class of drugs. And it's not even the labeled use. And you're spinning it into narratives. And it's kind of just absolutely wild to me to watch this play out.
Agreed.
All right. Well, unless you guys have any closing words, I think we'll wrap it up. Great discussion. Phil, Elliot, anything else?
Oh, I think we covered pretty much everything I had on my list. I thought it's a fascinating topic. I just wish I had either better, clearer answers or near-term opportunities, and unfortunately, I'm not there on either one.
So as always, if you're listening and you have either, feel free to send them our way. And if there's any thoughts that we've shared that you want to push back on, absolutely, let us know. Always like hearing such things.
I know for a fact there's a couple of people that are very sharp real estate investors who listen to this. So please point out where we might be wrong.
Yeah, and as a dyed-in-the-wool contrarian, it almost pains me to kind of be negative on something that the consensus is negative on. But I think, when you're contrarian, you've got to be contrarian and right at the same time. And, in this case, I'm just not sure what the right call is on commercial real estate. So, that's the only thing to do is to be on the sidelines in that case. So,
and chip away little by little, because you never know when exactly the opportunity will manifest.
Yeah, and we may revisit this at some point, because I don't think this topic is going away anytime soon.
Nope, agreed.
Totally.
Terrific. Thank you so much, guys, and thanks everyone for listening. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.